Let's get right into this explainer. We're unpacking Puig brand's early 2026 financial performance, the end of those Estée Lauder merger talks, and something I find absolutely fascinating, how their executive compensation is actually fueling their long-term growth. We're going to connect the dots between the hard numbers on the balance sheet and the behind-the-scenes incentives that make them happen.
Here's our roadmap for today. We'll kick off with the Q1 2026 earnings breakdown, dive deep into segment performance, check out that Estée Lauder dynamic, look at analyst forecasts, and wrap up with executive pay and strategy. Let's dive in.
Section 1, the Q1 2026 earnings breakdown. Now, the absolute standout figure here is a very solid 4.7% like-for-like growth for the first quarter. You know, when you strip away all the macroeconomic noise, like-for-like growth tells us the real story of the core organic business. And hitting near 5% in today's unpredictable global economy, man, that just screams brand resilience.
The crucial takeaway here is that Puig isn't just treading water, they're actively beating the broader premium beauty market. Leadership literally spelled this out in their sales update, confirming their 2026 outlook and showing total confidence in their ability to just keep outperforming their peers.
Looking at the raw revenue, they hit a massive 1,215 million euros. But honestly, what's truly impressive is that they pulled this off while fighting off a negative 4% foreign exchange impact from last year. That's 48 million euros shaved right off the top. They essentially powered through some serious currency headwinds and still landed in the green.
Moving right along to Section 2, a deep dive into segment performance.
This segment breakdown is pretty revealing. While makeup and skincare hold their own at 14% and 12%, the lion's share of revenue is coming from one dominant place. A whopping 74% of their business is anchored squarely in fragrance and fashion. This isn't just a side hustle, right? It's the undisputed engine driving the whole Puig enterprise.
And when you ground that data in the physical products, like those highly coveted iconic stiletto perfume bottles, it totally makes sense. It reminds us of the massive consumer desirability driving this sector. They posted a 3.9% like-for-like growth in this segment alone. It's a great reminder that behind every single percentage point is an actual product flying off the shelves.
All right, Section 3, the Estée Lauder dynamic.
This comparison perfectly captures the tale of two companies right now. You probably know the market was completely buzzing recently about a potential merger between these two beauty giants. Well, those talks have officially ended. So where does that leave us? Puig is sticking to a highly selective M&A approach, evaluating only opportunities with a perfect strategic fit. Meanwhile, Estée Lauder is turning inward, rolling up its sleeves to focus heavily on its profit recovery and growth program and optimizing its channel mix. Two totally different playbooks.
And the analysts have a lot to say about this. Piper Sandler notes that while the dead Puig deal adds some complexity to Estée Lauder's turnaround, their valuation has already reset. They slapped an overweight rating on it with a $95 price target, seeing some real stabilization in the Americas. Barclays is a bit more cautious, with an equal weight rating at $75, calling the recent quarter constructive, but definitely not a knockout. Look at the forward PE metrics, though, and some models suggest EL might actually be undervalued by nearly 4%. The big takeaway? Both brands are fiercely independent now, and the market is watching their every move.
Let's pivot to Section 4, analyst ratings and forecasts, specifically for Puig.
Based on 15 analysts over the last 3 months, the average price target for Puig stock is sitting at a very healthy 19.98 euros, with an overriding consensus rating of buy. Forecasts are ranging anywhere from 16 up to 23.60 euros. The street is clearly validating the momentum we just unpacked in those Q1 numbers.
Ultimately, Puig's management is selling stability, and investors are buying it. They're guiding for stable, adjusted EBITDA margins through 2026. Plus, they're committing to a 40% dividend payout ratio of reported net profits. To put that in perspective, that translates to a proposed 237 million euro dividend for the previous year. And crucially, they're keeping their balance sheet squeaky clean, targeting a net debt to EBITDA ratio of 2 times or less. That is some serious capital discipline.
Finally, Section 5, Executive Pay and Strategy. I absolutely love this part, because knowing exactly how leadership gets paid tells you exactly what they are obsessing over.
Let's quickly translate some corporate jargon. An LTIP, or long-term incentive plan, basically ensures that if the shareholders win over the long haul, the executives win too. So instead of just handing out fast cash for short-term bumps, Puig grants Class B shares tied to a 3-year performance period. It's all about profitability, growth, and genuine value creation.
Look at where the heavy lifting is in the 2026 short-term incentives. 50%, half of an executive's bonus, is determined purely by adjusted EBITDA and like-for-like net revenue growth. They are aggressively rewarded for profitable organic growth. The rest of the pie is carefully balanced across fixed costs, cash flow, ESG targets, and individual assessments.
It gets even more interesting at the top. The CEO's long-term bonus target is a staggering 220% of their fixed salary, paid out 100% in shares. But here's the real kicker. There is a mandatory 3-year holding policy, or they have to maintain economic exposure equal to twice their base salary. They can't just pump the numbers, cash out, and walk away. This literally locks the leadership team into the sustained success of the brand.
The whole point of these intricate pay structures is robust risk mitigation and long-term sustainability. The board even baked in malice and clawback provisions. That means if the performance turns out to be a mirage, or if risks were mismanaged, the company can actually pull that compensation right back.
So I'll leave you with this final thought. With the merger talks officially in the rearview mirror, a rock-solid balance sheet, an absolute powerhouse fragrance and fashion segment, and a management team financially locked into the company's success, is Puig's internal machinery perfectly tuned to completely dominate the premium beauty space through 2026 and beyond? The data we've covered today paints a remarkably compelling picture. Thanks so much for joining me for this explainer, and definitely keep your eyes on these numbers.